In this video, I'm gonna give you an intro to candlestick patterns. I know that you guys love trading just as much as me, so let's dive into what these candlesticks mean, how to trade them better, how to make as much money as possible by utilizing very proven tactics. So let's dive straight into the chart right now. What exactly are candlesticks and why are they useful? Well, traders will typically use candlestick charts to predict potential price movement based on historical trends when trading. Candlesticks are helpful since they display 4 price points. And before I go into the exact ins and outs of candlesticks, make sure to use my Bybit link below this video. If you want to trade Bitcoin, you get thousands of dollars in sign up and deposit bonus if you click the link at the top of the description and in the pinned comment. So here is the opening price, the close price, the highest price, and the lowest price. So the open, the close, the high, and the low. This price data displayed in candlestick charts serves as the foundation for numerous algorithms across the finance industry. Trading decisions are frequently influenced by emotions which are visible a lot more clearly in candlestick charts. So this is why traders are using them. The reason for this is because candlestick charts display momentum incredibly well. The price range between the open and closing price of a candle is represented by the candle body. When the close is lower than the open, the candle body will be filled in red. When the close is higher than the open, the candle body will be filled in green. So what are the red lines on top and bottom of the candle? Those are typically known as candle wicks or candle shadows, but I prefer to call them wicks. So wicks are directly above and below the candle body, and they represent the highest and lowest trading prices of that candle over a period of time. The length of these wicks can be used to analyze price action. This can in fact be used to show the momentum. So if a candle has a big wick and then another candle in the other direction, then there's a lot more momentum in that direction. But for example, if a candle has a smaller wick and then goes in that direction, there may be less momentum there. In short, the body represents the opening and closing prices, and then the wicks represent the highs and the lows that the candle has reached. Depending on the shape of the candle, as well as multiple candlestick patterns, using this effectively allows you to determine the momentum in the market on a general scale. Obviously, this doesn't work 100% of the time, but it is definitely something that many traders use and should not be ignored. And if you check Bybit, for example, they do use candlesticks in their charts. And if you do want to trade on Bybit, the link is down below, like I said already. Let's talk about candlestick patterns. To get you started, let's take a look at the most basic candlestick patterns so you guys can get a better idea of how to use them. A pattern will either be bullish or bearish. A bearish pattern suggests that the price will most likely decline, whereas a bullish pattern suggests that the price will most likely increase. Remember, this is not guaranteed, but it is a good way to get an idea of the momentum in the markets. Let's talk about the bearish engulfing pattern. You've probably heard this word engulfing a lot in my videos. When sellers outweigh buyers during an uptrend, a bearish engulfing pattern will typically form. This is when a small green candle forms and then a big red candle forms, which is essentially larger than the green candle, henceforth engulfing that candle. This suggests that the sellers are once again in charge of price action and the value may drop further. Equally, a bullish engulfing pattern is the opposite of that, so a small red candle being engulfed by a much bigger green candle. Next, let's look at a bearish harami cross, which is also referred to as a doji. I'm sure some of you have heard of doji before in our community. That's usually how I call them as well. This essentially means that a candlestick has closed roughly where it opened, creating a small candle body. However, one of the key factors of this is having wicks to both sides of the candle. This is a great indication of indecision in the markets. Seeing this after an uptrend would make you more bearish, and seeing it after a downtrend, that is a bullish harami cross or a doji, will typically hint that buyers are stepping in and price is more likely to go up for the next few candles. So in summary here, for candles using candlesticks, traders can essentially predict the direction of an asset, in our case crypto, but this does work on stocks or forex as well by analyzing the emotion surrounding via the shape of the candle or multiple candles forming candlestick patterns. Wow guys, I think that was an incredible little walkthrough. I hope you enjoyed it. Leave a thumbs up right now if you think I should make more of these trading tutorials for you guys. And subscribe right now and press the notification bell if you enjoy this kind of content. And if you want to get your $4,000 bonus on Bybit, you have the link down below. And if you haven't seen my latest technical analysis update on Bitcoin, you can just take your fingers and click right here right now. That's my latest update. If you want to see what Bitcoin is doing right now, see you over there. Bye bye.